Hello traders, we're here in the green trading room, found a great put spread candidate, and we wanted just to walk you through our thinking of the entire process of the trade. Everything, as you know, starts with a compelling pattern. This is a Lima Hotel Laboratory Corp of America. On the left here is a bullish daily, weekly on the right. So this had a nasty breakdown, greater than 100% retracement, slicing through this resistance. So I don't even need to look. This is going to be some type of breakdown failure bottoming tail on the weekly. See, I'm not even looking. Now I'm looking. Well, ugly red bar and, deep retracement. This now is bullish multi-week consolidation. So we then ask ourselves, do we want a directional play, which is a bullish stock or option directional setup, or an income trade, which is selling an out-of-money put spread? Whenever we have a directional, by definition, it's a candidate for an income trade, provided you go through your checklist, which means the options are liquid, it's a good days to expiration, and you're getting paid adequate juice, which is, we teach what that means in our courses, obviously. So now here's the discussion, folks. The 160s, we could sell the 160, and I'm just going to do them $10 wide for our discussion. 160, we sell this put, which means we put money in our pocket, and we take some of that money and we buy a 150 put, and that's a bull put credit spread. And the net credit right now is $1.10. My rough rule of thumb is I'm looking for 10% of the spread width. So 10% of $10 is $1, and this is $1.10, so it meets my test of adequate credit. Now, selling a put, as you know, we're putting money in our pocket, giving somebody else, the put buyer, the right, but not the obligation, to make us buy Laboratory Corporation at $160 on or before expiration, which is June 21, 30 days from now. We are technicians. This pattern highly suggests that it is not going to trade under this major support. This is beautiful. And here's our weekly. This is 1, 2, 3, even though today's Wednesday, so this bar is not finished. 3 bullish consolidation bars in the upper half of this bar. So daily, weekly are in alignment. So here's the question now. Do you want to put, and I'll just use a 10 lot for math, you sell a 10 lot of this, $1,100 hits your account immediately, and you have the obligation to buy 1,000 shares of this at $160, again, on or before June 21 expiration. Or do you want to sell a further out of the money put, the 155, and again, I'll do it $10 wide. 145 in the midpoint right now is 52 cents. So that is less than half the credit, but you have $5 tighter strike price. In either case, our stop is going to be under support here, under 60, 160, spot 50 or 40, whatever the case there. Well, it would be under the lowest point. Right there. So our stop is 160, spot 18, regardless of which one you take. How tight you sell is a function of risk to reward. If you do the tighter one, the 160, 150, and you get stopped out, you're going to have a bigger loss than the 155, 145. So it's a personal choice. Yes, you can look at return on capital. The return on capital is a lot bigger on the bigger credit one, of course. And then you can also, tinker around and do a $5 wide if you want, because there's only $5 wide increments and there are no weekly expirations, which is why I'm looking at the Junes, because I have no other choice. Take it or leave it. And so that's it. So I think I'm going to give the 160, 150 to our subscribers, but give them the option, if they want more cushion, less reward to risk, to go another $5 out. So I hope that helped. As always, email me, dan@mastertrader.com, and check us out in the green trading room. We find phenomenal trades like this all day long and give ongoing education. Good trading, everyone.